Hello everybody, thanks for coming. Those who don't know who I am, I'm David Haig, the CEO of Brand Finance, and I'm very pleased to say that we moved here in 2014, so we've been here 12 years in this building, and when we moved here we refurbished it and we launched the Brand Exchange Club. And in those days we had the bar downstairs and we had this room here where we used to do lots of events. And Brand Finance grew quite substantially, and as a result we had to surrender this room, and it was full of analysts doing their thing. But fortunately for us, working from home seems to have diffused them out around the counties, and so we were able to free the space and turn it back into the presentation room. And this is the first occasion where we've actually used it for one of our presentations. Now, if you've been to the toilet downstairs, you will have noticed lots of smiling faces on the wall, which include people like Keir Starmer and, dare I say it, Nigel Farage, who have all spoken here at the Brand Exchange. The idea was that the city, which is all where the coffee house movement started from about 1650, most of the coffee houses became places where people went and they would talk about a particular line of business, and from that various exchanges actually grew. So the Stock Exchange started as a coffee house, Lloyd's started as a coffee house, the Metal Exchange, they all started as coffee houses. And so our pretentious idea was, when we moved in here, we would call this the Brand Exchange because it's a coffee house that's going to become a place where brands meet finance. So that's the concept behind all of this. So it's great that we're actually back in here doing these events. The intention is that they're actually meant to be pretty informal, and that if you feel inspired to ask questions and argue, please feel free to do so. I'm very pleased to say that today we're launching our tech platform, our tech study. It's one of many reports we produce. What many people don't realise is that we claim to be the world's leading brand valuation firm, and part of our substantiation for that is that we actually get financial data from various places. We now get original market research from various places, and we put it all together and we do strength analyses of the different brands and valuations of the different brands. And even I was surprised the other day to discover that each year we are valuing about 11,000 brands globally, and of them we actually publish 5,000. So one of the ironies is we promote ourselves a lot and people say we do a lot of PR, and we do quite well on our PR, but that's a lot of brands and a lot of people out there. So not everyone even knows we are doing this. And I met someone the other day who said, "Oh, you don't have anything on us, do you?" And I went and looked and I said, "Oh yeah, we've been valuing your brand for 12 years. And he said, "Oh, well, no one at our end knew." So our challenge is to actually get out there and let people know what we're doing. And the other challenge is to actually illustrate what we're doing and inform and improve what we're doing by, getting better information about them, which actually segues into the subject matter, which is technology. And the hot topic with technology is AI. Even I, being totally ignorant about all things technology, can see from what I've heard that AI could transform our business, by improving the way in which we do those 10,000 brand valuations, but more importantly, how we actually understand the companies behind them and how we communicate with the companies behind them. So our challenge is to use AI to accelerate the growth of brand finance. I had lunch with someone today who, in the course of the lunch, said, "Oh, did you hear about WPP? They just sacked 20,000 people because of AI." So I looked it up, and it's not true. They've only sacked 4,000 people out of 104, so less than 4% of their workforce since the beginning of January. So unless something has happened that hasn't hit the press, it's just one of those rumours. And that's one of the interesting things about AI. There's all sorts of panic and rumour and God knows what. And I'm pleased to say that is what the subject of our panel will be. We're very lucky to have Rupert Kemp, who was very lucky to work here at Brand Finance for a few years. till we finally got rid of him to LBS. And then the idiot went to work for Google. And he now works for one of the brightest guys in the world. So, well done. So Rupert is going to give us a point of view about the impact of AI. And I asked him, could he tell us what the impact of AI would be on marketing? And he said, well, I don't really know, but I don't mind coming along and talking in the brand finance tradition. So Rupert is going to sort of give us some indication of what he thinks it will do, but don't expect it to be 100% true. And Navin Ramahan from Infosys is going to come and joust with him about how that works. Navin looks after the marketing segment for Infosys, so probably has a better idea than most about the mass panic which has set in the marketing industry about what AI is going to do to everyone. So that will be our panel. But prior to the panel, Lorenzo, our esteemed head of this subject, is going to give you the results and tell you what it all means. I'm looking forward to hearing it because I don't really know. So over to you, Lorenzo. It's your floor.
Thank you, David. Thank you very much, and thank you for being here. I'm Lorenzo Coruzzi. As David said, I lead the tech and IT space at Brand Finance, and today we'll be looking at a few of the interesting facts and insights that we uncovered as we were investigating the Tech 100 ranking. I have a couple of words about Brand Finance. David covered some of them, but just a recap of why we are here. Our credo, effectively, our mission, which is bridging the gap between marketing and finance. So effectively supporting and helping marketers to pass the message of how important is their work and demonstrating the value that they do to finance people and the board. And on the other side, effectively provide finance and board with an understanding of how much value marketers bring to the table. And we do that through effectively structured approach. The first thing for us is the measure part, so establishing a baseline. Effectively, what we do, as David mentioned before, is we measure the strength of the brand and then we value them. So we do that through brand scorecard and brand strength analysis and valuation. And this is really just a base case brand value for us. It's sort of a line in the sand. We understand how much we are worth today, and it's a sort of picture, if you want. And the whole process about building brand value over time is, okay, what do I have to do then to enhance my brand equity, effectively to manage my brand effectively? And one of the most important things that we encourage people that take care of brand, but also organization as a whole, is to develop a brand ambition, a brand vision. So where do we want to be in 5 years' time, compared to where we are today, and set some targets, actually, some objectives, real objectives, so that we can, address those targets and actually build value over time. The third part is leveraging brand equity. After you build brand equity, so maximize the value that you've built through product extension and market expansion, and we've seen brand doing it successfully globally. And the ultimate, let's say, the highest part of it is building scale through licensing, franchising, and partnership. This doesn't apply necessarily to every sectors that you operate in, but in various categories in tech space, it applies. We have the largest brand value database in the world, and we publish, we're very active in publishing. We publish more than 60 sector reports a year, more than 30 regional reports every year, and we have also specific publications like the B2B brand, the Soft Power Index, the Employer Brand Index. So we are very active across every different sectors and geography and brand-related subject. As David said, over the last 10 years, we have developed our research capabilities quite a lot. Every year now, through our global brand equity monitor, we research more than 31 sectors in 41 countries. We have a total of 150,000 respondents globally, and we research more than 6,000 brands, and then 5,000 we publish, as we say. One of the things that goes beyond all of this research and all of this valuation is one of the things that we care about is demonstrating the value that the brands bring to the table. As we said, is one of our mission. Recently, we've developed with Legal and General Investment Management actually an ETF that is publicly available on which everyone can invest, and it's based on our valuation. It's based on our results, and specifically on the top 100 global brands. And what we've seen is that strong brands and very valuable brands deliver superior return from a shareholder perspective, return on equity and operating margin. And this is against the benchmark. This is just to show that building strong brand delivers substantial value effectively, and it's a tangible proof of it. Before entering into the details of the Tech 100 value and all of the insights, we wanted to take a step back and look at sort of a helicopter view. What is the global intangible value? Just to get an idea of the size of this economy. The global total intangible value reached almost 100 trillion in 2025, making it a 22% increase year on year, with tech accounting of basically a third of it. When we talk about this global intangible value, what we are saying is that if you take 100% of the total value of a company, effectively, 100 trillion is the 50%. I'll show you here because it's clearer. Effectively, that 100 trillion is 50%, 58% of the world economy, which is intangible. And on average, 83% of the intangible value is undisclosed. So what we are trying to measure here, what we are trying to show through this study, which is the Global Intangible Finance Tracker, is that when you look at enterprise value of the company, half of the value, on average, doesn't sit in the balance sheet. And the things that we want to say is, well, through the brand valuation, you can actually understand part of the value, and through the understanding, try to manage it over time. For tech companies, that is actually even bigger, because tech companies are actually amongst the most intangible companies that there are in the world. So 85% of the total company value is actually intangible, and the majority of it, 92% of it, is actually undisclosed. And the key point is that the brands sit in that space that really it's to a certain extent not recorded anywhere. So having looked at those numbers, what is the cumulative value of the top 100 technology brand? It's 3.7 trillion. 3.7 trillion, which is a massive number, with brands accounting on average of 40% of the enterprise value. Again, this is a very important point that we care about to pass as a message, because whenever there is a budget discussion or there are cuts that have to be made, very often brand and marketing is one of the places where they start cutting costs, when in reality, the message that we want to pass here is that you are cutting costs for an asset that is worth billions of dollars, and it's on average 40 to 15% of the overall value of the business. So in reality, you can look at it almost as a value at risk for the business. So how strong brands then create financial value? We're going to see now a model that we've developed over the last couple of years at Brand Finance, looking at brand strength and how we link it to brand value creation. In a summary, if you want, when you look at strong brands, they create value through revenue growth and profit margin that brings reliable earnings and lower risk, which can be seen when you value companies, and overall determining value. And this is our model, really. And those elements, and I'll tell you now, are linked to the customer behavior section. But if you step back, we see the brand strength as part of a wider brand management system, where you have the listen part, which is listen to market signal and trends. We have the diagnose part, which is taking a picture of where the brand is today through a number of metrics, which I'll explain in a moment. And then, of course, act. So define the imperatives, and as I said before, set the targets so that you can try to achieve your brand ambition over time. The diagnose part is the important one, where we've developed this framework, which when we calculate the various brand strength index, effectively works as a balanced scorecard. And you have brand perception on one side, looking at brand knowledge, brand credibility, and brand appeal, and customer behaviors that follows. That looks at selection, price acceptance, and advocacy. The key concept behind it is really are grounded in marketing science. You know, brand knowledge, we know it's linked to availability heuristics, so a brand have to come to mind in buying situations, so you have to understand, you have to be familiar with the brand. Credibility is about loss aversion heuristic, and this is actually quite strong in certain sector, and some sector included in this Tech 100, for example, B2B, where, you know, you're making a choice thinking that, you know, probably is the less risky choice that you can take in a certain buying situation, but you need also that appeal part, that positive connection part to be connected with the brand. These three things, effectively, the way we think about it is, you know, I know you, I trust you, I like you, will drive customer behavior. So will drive selection, which is about consideration and preference, will drive price premium acceptance, and recommendation and word of mouth. And as I said before, you know, if you look at consideration, preference, price acceptance, these elements are the ones that are linked to what I was saying before, how strong brands create value, about growth and sustained revenue, but also sustained profitability over time. This is our, it's the methodology that we use to determine the brand value. So brand strength really is only step one, the brand strength, where we derive a brand strength index out of 100. And then we move on. We use a royalty relief approach, which is an approach that is grounded in commercial reality. Second step is to determine an appropriate royalty that you could be used to license the brand in your sector. Third, apply this royalty to forecast revenue growth that we take from S&P Capital IQ and Bloomberg IBS, and we discount that back to a net present value, which is the value of the asset effectively, is the brand value today. So looking at the results for this year, you can see here the top 10 of our Tech 100. The most valuable brand is Apple, followed by Microsoft and Google. Then you have e-commerce, semiconductors. It's interesting, actually, when you look at the top 5, you have electronics, software, media, e-commerce, semiconductors. So you have a spread of the sectors that we include in Tech 100. The other things that we think is quite interesting when we look at this slide is the predominance of US brands in the top 10. Actually, 8 of 10 of the top brands are US brands, actually. And when you look at the whole 100, not just the top 10, US accounts for almost 80% of the top 100 tech brand value, with the second biggest, actually, proportion, which is China, with only 13%, which is comparatively a lot lower. And over time, we had a look at how the brand value developed for the different countries, especially, you know, the first 2 countries in terms of brand value contribution. And what we've seen is that US have moved from 623.8 billion to 2.9 trillion over the span of 10 years in brand value, growing 88% between 2015 and 2020 and 150% almost over the last 5 years. While China grew from 75 to 500 billion almost. So that's 500% plus growth over the last 10 years. And that's not just in terms of value, but also in terms of number of brands that actually are included in the Tech 100, which move ahead. And today are 25 brands, actually, so quarter of the table. It's interesting how we've seen these US growth development, especially over the last 5 years. We think this is down to, you know, of course, you have access to capital, you have very big innovation hub. But one of the key things we think is they've built very strong brands, actually. And on the other side, you see, especially over the last 5 years, China has slowed down a bit following 2020. You know, there have been geopolitical tension, various challenges for Chinese brands to keep expanding in the world. But nonetheless, as I said, you know, China still is the second biggest contributor. Another thing that we thought was interesting is to look not just the cumulative value, but where do brands sit across all different sectors that we cover in our Tech 100. And as you can see here, we have brands from electronics, media, internet and software, e-commerce, semiconductor, IT services, and leisure tech. And you can see that, for example, Chinese brands tend to be more on the electronic side, the e-commerce and media. And if you think about, if you have some Chinese brands that will come to mind, even they are managed to become very popular in the Western world, you will think about Xiaomi or Huawei or an Alibaba, and that is the place where they play the most. On the other side, you can see that US brands are not particularly strong in terms of number of brands that are in the table in electronics, but the majority of brands actually is in internet and software and in semiconductor, critical sectors for the current AI revolution. Interestingly, IT services, we think it's a bit of a specificity, and we know that there are different countries in which IT services standards have been developed over time, one being India, for example. So yeah, it's a bit of a different dynamic for that. One other thing that we always look when we look at our ranking is the brand value growth. And the interesting thing here, compared to the top 10 brand value, for example, first of all, is that you have a bit more of a balance in terms of Western and Asia dynamic. You have 4 out of 10 brands that are Chinese, actually, Wistron, Xiaomi, CATL, and WeChat. But even more interestingly, potentially, is that out of the top 5 fastest growing brand in the Tech 100, 4 were actually semiconductors brand. And there is an interesting dynamic in semiconductor that we look at brand finance as well, where you can be a very fast-growing brand, like in this case semiconductor, because of course there is the whole infrastructure and computing related AI revolution. But cumulatively, the overall brand value of semiconductor brands in the Tech 100 is still relatively low. So we see that our brands, they are gaining a lot of momentum, but they're not yet very high contributor in the overall 100. One of the reasons is that all of these sectors in reality have a different role of brand. The brand plays a different role in determining and guiding and driving value for the business, whether you are in semiconductor, in electronics, or in software. When we think about growth and brand value growth, there are really 3 levers that you can think of that can help you develop growth over time, which you can think of as a spectrum almost. One is the brand strength, which we see here, which is more highly controllable, which is based on the model that we showed before. So brand knowledge, brand credibility, brand consideration. That's let's say, the more controllable part that you have. The other is business growth, business outlook, which is partially controllable depending on where you invest, where you expand, and the other is macroeconomic factor, which is something that you can't control really. So when looking at brand strength, these are the strongest brand in the top 10. You can see a lot of media brands, brands that we use every day. Naturally, through our global brand equity monitor, they come up very strongly. But you can also see brands that are not necessarily in our every day, like semiconductor brands or some others that came up very, very strongly. Brand strength is a very important indicator for us. It's actually an indicator of future performance. We've run analysis on our brand strength and our research, and what we saw was that overperformance on brand strength versus current usage is actually a lead indicator of growth. The idea behind it, and it's quite logical, is that if you are a very strong brand in a market where you still have a low usage share or a low market share, naturally that means that you have a positive momentum in the market. So very likely you will be capturing market share. This year we had also 2 new entrants in the Tech 100. It's very difficult to enter in a table that is growing quite fast. But we had 2 new entrants, OpenAI and Anthropic. Relatively, speaking, there is quite a distance between the 2 in brand value. OpenAI valued at 14 billion, Anthropic at 5 billion. The fact that OpenAI entered 31st is impressive, considering we think that, until a few years ago didn't exist. And this makes us think as, how fast through AI potentially can brand develop over time, and at the same time potentially can brand be destroyed. Because one thing is to grow brand value very fast, because maybe you can get 100 million users in a week or in a month, and you can grow your user base very fast. But are you growing your brand strength fast enough as well to be able to maintain that loyalty and that equity over time? We did this research last year, and we shared here a few data points on the familiarity, consideration, and preference of these brands, Anthropic and ChatGPT, OpenAI. And we can see how, definitely ChatGPT had an advantage. It was the first to market with this widespread recognition. And to a certain extent, it's kind of becoming, for the people that are not into the specificity of the various dynamics of the LLMs, the brand to go to, to do your checks or to sense check some of the things that you're using. Of course, more recently, especially in the last week, news came out of Anthropic latest Claude release, which might change this dramatically. And even the brand value of Anthropic, if you think that we calculated this in between December and November and December, it might have changed already substantially. One point about, let's call it about, diagnosing how do you grow your long-term brand equity, is about understanding what are the things that matters as well. Here we are putting together a couple of different studies that we've done. On the left, you can see the IT decision maker study, where we interview IT decision makers, and on the other, our global brand equity monitor results. So it's a consumer sample. But the interesting thing we thought was very interesting is that there are clear similarities of what they think it's important to create a brand that has a potential for long-term brand equity. The first one is customer orientation, or the importance of customer service. The second is innovation, in its different forms, if you want. It could be deep expertise in AI, you bring in innovative solution, a range of products or model of simply an innovative spirit. And the last one is trust. And we actually try to go a bit deeper on all of these elements. And what we found is that trust came out across most sectors as one of the most important drivers. And this is not related to tech. As you can see, this is our global study that I was mentioning at the beginning. You can see that here we cover utilities, insurance, real estate, logistics, all of the sectors that we cover. And you can see how important is in driving consideration, which is a key metrics in the brand strength, how important is trust in driving consideration. And very often is one of the first driver across all of the sectors. So then we thought, there was an opportunity, effectively. There was an opportunity to try to define trust maybe a bit better and find a way to think about trust that was scientifically proven, and that could help company to build trust over time with specific actions. First of all, this is the brand finance trust model that we've developed. First of all, there are different types of trust. Trust is made of different things. There is a functional trust, which is about competence. I know that you can do this certain service that you're selling. There is a relational trust, which is a bit more emotional, which is feeling that the brand is on my side. And then there is a principle trust, which is not about me, it's about the wider society. It's a brand that acts with integrity effectively. But again, even when you think about these things, there are different interpretations that you can give that depends and are different based on the geographical location in which you are, on which you operate, but also change in time. And we have seen with AI, for example, how trust is changing quite rapidly. All of these things should be connected to a brand strategy and the desired attributes and behavior that you want to push out. They are connected to your brand strategy and can be done through identifying specific KPIs that can be connected to the different type of trust. So what are those KPIs? They are linked to your brand strategy that can help you on developing functional trust, relational trust, or principal trust effectively. And then you can activate those through product services and other platform with the final measurement effectively to see whether it's effective or not what you are implementing and whether you are implementing trust. And of course at Brand Finance, which is what we do, the idea is to link then this element to performance and to value creation.